Hello everyone, my name's Paula Laird, a partner in the banking team at Squires. A very warm welcome to our webinar today, which is entitled Challenges and Opportunities Facing Business in 2024, a Global Outlook. We're holding this webinar in association with our Women in Finance network to celebrate both Women's History Month and International Women's Day, along with other events which are taking place across our network. However, please don't dial off if you don't fit the description of a woman in finance, because we have a really fantastic panel who are speaking today to guide us through the really big picture issues that we're all facing, the economy, geopolitics, and ESG. So I'd like to welcome our speakers and thank them very much for their time. We have Matthew Kirk, former ambassador and head of international affairs at Squires, Liz Martin, a senior economist at HSBC, and our own Lucy Webster, who's a partner in our litigation team at Squires. And without further ado, I'll hand over to Matthew.
Well, thank you very much, Paula. So I'm obviously the token man in this Women and Finance event. And I'm going to be leading through a conversation with Liz and Lucy about the issues that Paula just talked about. This is obviously a year of huge political uncertainty, also considerable economic uncertainty. So maybe we could start with the economy, and Liz is in a fantastic position to help guide us through that. And Liz, I think you have a couple of slides. If you could use them just to talk a little bit about where we are. Europe is sort of a bit in the doldrums, the UK too, the US seemingly performing much better. What's the economic backdrop that we're looking at the moment?
Well, thank you, Matthew, and good afternoon, everyone. Yeah, look, we have been in the doldrums. I think, my message, if I had just a couple of sentences to deliver one, would be, look, times are better, things are improving. We are looking towards a better year ahead in 2024. But the bar is very low. In the UK, we ended the year in recession. GDP per capita, and this is true not just in the UK, but other parts of Europe and other parts of the world, GDP has been rising, but that's been driven by population growth, and GDP per capita has actually been falling. So the bar for improvement is low, but it does feel like we are improving. So the slide that you see on your screens, hopefully at the moment, is the PMI survey of activity across sectors. And you can see an improvement across the three main sectors in the last in the last few readings. 50 indicating growth, so construction almost back into growth territory, and for the UK, the all-important service sector standing at an 8-month high. Matthew, you asked about Europe, so if we move on to the next slide, I've got a couple for Europe. I mean, first of all, the exact same thing, the PMI survey on the left, not quite as much improved as the UK, but certainly pointing in the right direction. And on the right-hand side is a business sentiment index. And what you notice about that one is that there is a notable exception to this trend of improvement. And unfortunately, that trend, that exception on the downside is Germany. And in Germany, I think where they've been highly exposed to a slump in global manufacturing, highly exposed to energy prices, had a bit of a boom and bust in housing as well. You look at all of the indicators, and Germany, unfortunately, does feel like the sick man of Europe at the moment. So Germany's the exception on the downside, but on the upside is the US. And the theme of the last couple of years really has been this outperformance in the US relative to other developed markets, which is really notable and marked, and just a couple of reasons why that might be. I mean, first of all, it's energy self-sufficiency. One of the big reasons why we've had a slowdown here in Europe has been our exposure to the very high energy prices as a consequence of the situation in Ukraine, and the US, because of its energy self-sufficiency, just hasn't had that. So it's had a pretty speedy post-COVID reopening. I think it's had a good response to inflation, so it's not been immune to the inflation pressures, but the Federal Reserve, I think, dealt with them quickly and credibly. And then the other factor, of course, is government stimulus. So Joe Biden and the Inflation Reduction Act, the CHIPS Act, these are big investment programs, and they are successful in generating growth, investment and jobs. So that's, I think, why the US has been really outperforming, but a better year, hopefully, for us here in Europe.
And Liz, looking perhaps specifically at the UK again for a moment, we've obviously, coming out of COVID, we have hugely elevated debt levels. And then, as you said, the economic shock of the energy crisis caused by the war in Ukraine and what that did for inflation and so forth. So do you think we've reached the peak of the interest rate cycle? Are we moving into more benign waters in terms of inflationary pressures as well? What do you think the UK looks like in the coming year?
Yeah, I'm happy to say I think we are. We've certainly peaked in terms of inflation, and hopefully we've peaked in terms of interest rates as well. So the chart on your screens right now shows you our inflation forecast, and actually, if we look at inflation, sort of breaking it down by kind of category, food inflation is down a lot. Energy is in deflation because gas prices, and it's kind of a miracle really for Europe that gas prices, we've had 2 mild winters and gas prices are now back below pre-invasion levels, and that in itself is taking UK inflation on our forecast below the Bank of England's 2% target by the middle of the year. So kind of May, June time will be temporarily at least below 2%, and then kind of bouncing a little bit, but certainly much more in the ballpark that the BOE will be happy with. The remaining question, like I said, food is down, energy is negative, and non-energy goods is moving in the right direction. The remaining bit that the BOE and central banks around the world are still worried about is wage growth driven service sector inflation pressures, and that's seen a less decided turnaround. And by the way, we'll get the new number for this tomorrow, so we'll see whether we do see that more of a turnaround. But where that comes from is wages and the labour market. And so, just to talk a little bit about the state of the labour market, everybody will know that a couple of years ago, the labour market was in an absolute frenzy. You couldn't fill positions, and this was across sectors, it was across skill levels, it was across geographies. Wherever you looked, it was very, very hard to get the staff that were needed. But look at this chart now on the left-hand side. UK job vacancies have fallen a long way, and we're now kind of back down to pre-pandemic levels on this measure. Now, this isn't a bad news story. It probably looks a little bit like a bad news story on the face of it, but actually we've had way too many job vacancies, and it's given us this wage-driven inflation pressure. So if the labour market can disinflate without a big rise in unemployment, but through a fall in vacancies, well, that is Goldilocks, as I've alluded to in the title. If you don't believe that, if you don't believe this middle of the road Goldilocks way is possible, then you have to believe one of two things. One, the economy is going off into recession, and it will take much more economic pain to deliver lower inflation, which is possible. Or the economy is not going to go into recession, but pay growth and inflation and interest rates are going to stay high for longer. So those are kind of the three worldviews, and I'm happy to say we are in that middle of the road Goldilocksy kind of world on our forecast. So just my next slide just quickly is on the Bank of England and the interest rate path, and you can see our forecast here is the black line, whereas the two other lines are the market pricing. So our forecast is that the first cut will come in August, and then the bank will cut gradually from there. So one cut per quarter, not per meeting, but per quarter, and that will take us to 3.75 at the end of, or 3.75% at the end of 2025. Now, if you look at the market pricing, you can see it's shifted quite a lot. So at the end of last year, there was a couple of really low inflation numbers, and that suggested that that the market thought, oh, inflation is going to come off very, very quickly, and interest rates are going to be cut very quickly, and the market pricing went to where the grey line is here. Since the start of the year, we have had better news. I showed you the PMI surveys and the business confidence surveys. There's also, house prices going back into positive growth territory. Consumer confidence has risen, generally better sentiment. And of course, a stronger economy means stronger jobs growth, stronger wage growth, stronger demand, and potentially higher inflation and interest rates. So the question is, can the BOE deliver? And I think it can and will, because natural gas prices are helping inflation to come lower, but perhaps it won't be as quick as what the market was expecting at the end of last year. Because it's still uncertain, and even if the labour market is slowing down, there's a couple of reasons to think wage growth stays high, and one is of course the government's national living wage, which comes through in April, another 10% rise, and that's against the backdrop of what we forecast to be 2% in inflation. So it's a huge 8% real terms pay rise, which potentially is going to be somewhat inflationary. So I think a gradual path lower, but certainly I hope we have reached the peak and the next move is down.
And we don't, of course, exist in a vacuum. We are very much dependent, in some ways more than many other economies, on what's going on in the global economy. So I wonder if you could say a word about that, commodities, the outlook for energy supply and price. How is the global market coping with this extraordinary set of circumstances that we've seen?
Yeah, absolutely. Well, I think thank you. That might turning to this slide. First of all, on the politics, I am struck over and over again by how many of our corporate customers that I speak to up and down the country ask me about Donald Trump. They're not asking about Keir Starmer and Rachel Reeves. They're asking about Donald Trump and what that really means. And the reason they are asking about that is because Donald Trump's policies are potentially going to have an impact on the global economy. And then you can see from the betting odds chart here on the right hand side that nobody knows what's going to happen here. It really does feel very 50-50. But of course, what we do know from Donald Trump from 2016 is he generally did deliver the policies that he said he would deliver. So when he's talking about a 10% export tariff or 60% for China, we need to listen and base case that if elected, he would deliver that policy. So generally, that is a further move down the road of deglobalization, making it harder to move goods and services around the economy. And generally, that causes a little bit of supply chain friction, but also a little bit of inflation, and that adds to a world where we've already got plenty of supply chain and inflation issues already. So if we move on to my final slide, just on the geopolitical risks. So we've already got, forget about Donald Trump, there is already a complicated global economic backdrop. We've got the three conflicts really: Ukraine, Gaza, and the Red Sea, all of which threaten to have implications for again global supply chain and prices. Actually, if we look at the freight rates, the chart on the left hand side, I think three positives here. One is we haven't gone to that 2021 peak level, and we're not going to, and that's very good. Two, we found that ceiling. As you can see, it has turned around. You don't even need a magnifying glass anymore to see it. The turnaround is marked, and hopefully that will continue. And third, when we talk to companies that are shipping goods around the world and importing goods, they're telling us that generally they are, yes, paying more in fuel. And my favorite statistic is that if you are not going up the Red Sea and the Suez Canal, but instead going around the Cape of Good Hope, it's actually costing you an extra $1 million per shipping unit in fuel costs. So absolutely huge. But companies are saying that they that is offset by not paying the fees to the Egyptians for the use of the Suez Canal, which has problems for Egypt, but that's another story. So better news on that front. And on the right hand side, I mean, is the oil price. And all I can say here is so far so good. We can see that it has been rising through 2024, but you look at that recent peak, and it actually peaks just before the Hamas attacks on the 7th of October. So extraordinary, really. I mean, leaving aside, the devastating humanitarian cost of that conflict, I think when we got the outbreak of conflict in the Middle East, it rang a lot of bells from 1973, because in 1973 we had inflationary conditions already. And then conflict in Israel led to the oil embargo, led to the oil price going skyward, and UK inflation and interest rates, and around the world inflation and interest rates following suit. So I think, you know, the initial economic response was, well, is that going to happen again? But you can see from the chart we're still way below that peak which happened before the attacks. So all I can say on the geopolitics is, you know, geopolitics always threatens to be an inflation risk, but both of these factors, it's really a case of so far so good.
Well, thank you, Liz. We'll come back to geopolitics in a minute. I just wanted to give Lucy a chance to comment. Maybe Lucy, you know, a little bit about what we're seeing as a firm in terms of our clients. How much are they showing the stress of this uncertainty? How much are they navigating all of this with confidence?
Yeah, thanks, Matthew, and good afternoon, everybody. I think it's really helpful to hear that from Liz in terms of the more positive outlook. I think generally with our clients, there's still a cautious approach, but perhaps some cautious optimism coming in there. I mean, there's still an uncertain and challenging outlook for our clients, you know, in terms of higher interest rates still at the moment, persistent supply chain challenges across the world and disruption, and also kind of a cautious stance taken by lenders, I think, as well, in terms of underlying risks, and that continues to pose significant challenges. It's perhaps squeezed our smaller clients and smaller companies a bit more than the larger companies so far, but those challenges still remain, and I would say particularly on the kind of the supply chain disruption side in particular. Colleagues in the M&A space may say that they've seen a slight slowdown in activity, and that sometimes can be a bit of an indicator around these things. But ultimately, we're seeing corporates and clients pricing in the risk. We've all seen that ourselves, I think, in terms of just higher prices generally, and that's either being passed on or it's just being factored in as a risk at the moment. In terms of clients more generally, what's interesting to see is that they're jumping at the chance to discuss these issues with us, and that's not uncommon, of course, but I think we're just seeing a slightly that they're wanting those opportunities a bit more, just to kind of understand what we're seeing across the board and seeing with other clients as well, which is obviously really interesting. But despite the caution, I think most companies are still wanting to progress and look at opportunities to grow. They're not stopping down operations entirely, but I think cautious optimism and seeking to grow still is still on the cards.
Thank you, Lucy. So turning a bit to geopolitics, and I'd offer a little comment, which is a lot of people have written about this as the year of democracy, the year of elections, more people in the world living in countries that will have some kind of exercise of democracy this year than ever before in history. And that's showing some interesting trends and tendencies. I think some elections are more consequential than others. You mentioned earlier, Liz, that more people are interested in whether Donald Trump is going to be re-elected than in the results of the UK elections. I would maybe slightly unkindly say I think the UK elections are among the least consequential in that the constraints on the UK economy are such that there isn't a lot of freedom of manoeuvre for whoever's elected to do radically different things. You've also got elections happening in some countries which have a less democratic feel to them. We've just had the chance to celebrate the triumphant re-election of President Putin in Russia, which will have come as a great surprise to many people, I'm sure. I'm not sure how consequential that election is in the grand scheme of things. It doesn't really change the outlook. But some elections are undoubtedly extremely important to the global future. And obviously, we have the US election towards the end of the year, the Taiwanese election at the beginning of the year, also a critical one, which in terms of the fault lines of geopolitics and where pressure comes from, matters hugely. And we have coming up in probably a couple of months, the largest exercise in democracy that happens in the world in India. And India playing a very interesting role in geopolitics at the moment, having traditionally been broadly in quite an antagonistic relationship with China and very close to Russia, now finding that the Russian friend is sort of in bed with the Chinese antagonist. So India facing a need to redefine in many ways the country's strategic future, and doing so with a very confident and very strongly led but increasingly Hindu nationalist government. So a backdrop in which we see governments, the European Commission as well, looking to levers that help manage uncertainty and help manage the stresses that it delivers. And that, broadly speaking, tends to lead to greater protectionism. We see that in the US, whether it's Trump's 10% tariff or Biden's massive subsidy programs. We see it in the EU with the debate about strategic autonomy. And these protectionist pressures, I think, are part of an unwinding of a globalized system that we've enjoyed for the last sort of 30 years or so, really up until a couple of years ago, in which you could, broadly speaking, do whatever business you wanted to do, wherever you wanted to do it, without having to consider significantly the geopolitics of doing so. So we're seeing national security being used as a means of protecting the economy as well as protecting national security. And we're also seeing in the exercise of democracy a growth in what are popularly called populist voices. These are voices in politics which try to respond to those who feel that the last 30 years of globally driven growth have not really delivered for them. And I'm always interested in how people talk about and how politicians talk about GDP as though GDP was a completely evenly distributed statistic across the entire population. Some people do very well even when GDP is not performing well, and some people see very little benefit from persistent GDP growth over many years. So I think all of those measures mean that we're looking at a future in which there will be greater pressure clearly on immigration, greater pressure on foreign investment and the perception that foreign investment is squashing our own labour market or our own wage packet. And we'll see politicians, whether they're operating within mainstream parties, as we see with Trump in the US, or whether they're operating in parties which attempt to displace the mainstream, as you see particularly, for example, in a country like France. We'll see those pressures pushing our politics, I think, in a more protectionist direction. And I wonder, Liz, this is slightly unfair, but you sort of started it talking about geopolitics as an economist. If we look at that, to what extent can you see the effects of these political shifts in economic performance? To what extent do you think governments are actually able to redirect economies to deliver for those who perceive themselves to have been left out of the growth picture over the last 30 years?
I think that's a really difficult one, isn't it? I mean, I think we certainly see people voting out of what's been termed economic anger, economic unrest, you know, feeling, as you say, left behind. I think, you know, the big example in the UK would be Boris Johnson and his levelling up programme. So, you know, winning over a huge section of the so-called red wall seats on a promise of redistributing and having something much more equal. I think, you know, delivering that ends up being a much harder thing to do. I mean, obviously for Boris Johnson, we can't blame him entirely. He had COVID and Ukraine and lots of other challenges that came along in the meantime. But, you know, I think successive governments have kind of pledged to do this and would surely want to do this to even things up a bit and you know, reap the benefit politically, but it has tended to be, I think, quite hard to deliver in reality. And I think the reason for that is that, you know, wealth attracts wealth. If you have a wealthy area of the country, that's where the investment tends to go, and it ends up only widening the gap.
Absolutely, and thereby creating pressures which issues such as immigration tend to exacerbate. Maybe a slightly cheeky question for you. You know, I said this is the year of democracy in many ways. Churchill, who was always a good one for a quip, famously said that democracy is the worst form of government, except for all the other forms that have been tried from time to time. If we look economically, does democracy actually work? Is it capable of delivering the sort of long-term decisions that other forms of government maybe address better? Can we draw any lessons from that?
Well, I think obviously, you know, some of the most advanced economies, of course, are democracies, so we can't say that it doesn't. But then again, I mean, I started my career in the Middle East in the Dubai office of HSBC, so I have seen a shall we say different form of government in action. And you know, for those Middle East and Gulf states, they certainly are not sort of sitting there worrying about what the voters are going to think, or I'm thinking about big projects. In the UK, of course, HS2, lots and lots of democratic kind of opposition to that, which probably slowed things down, increased costs, etc. You know, that wouldn't be a worry in a less democratic environment. The other undemocratic suggestion I've heard is obviously, you know, one of the big things we talk about in the UK is constrained supply of housing. And why have we got constrained supply of housing? It's often because of planning, and that often goes back to politicians not wanting to offend the voters by allowing, you know, big developments being built in people's backyard, as the expression goes. So again, that's an example of democracy getting in the way of what, you know, a robot economist would say would be the best outcome. And I have had a suggestion from those in the real estate community who've kind of said, well, actually what we need to do is take it completely out of democracy. So monetary policy, interest rates is not delivered by the government, it's delivered by an independent committee. And this argument would go that we would have a planning committee that would make the best decisions for the economy, regardless of electoral concerns. Of course, that would be not undemocratic and therefore won't happen. So I do think, you know, there are ways in which democracy can cause obstacles. But of course, what we also need to have in any strong economy is a strong institutional framework of checks and balances. So if you're a company operating in an undemocratic country, you know, it might all seem to be going very well because you're not worried about what voters think. You can get permission for your project or whatever it is. But you also want to know that the government isn't going to turn on you, that the institutional framework is trustworthy. And that, of course, is what you do get in democracies that you might not get elsewhere.
Absolutely, and I think it's very easy to take sort of two counter examples and try and draw universal conclusions from them. One, you know, the United States is undoubtedly the most successful economy that the world has ever seen, and it's an untidy and scrappy democracy as we see playing out on our television screens more or less every day. But at the opposite extreme, Singapore is not particularly tortured by democratic controls, and yet has produced an institutional stability and a really impressive economic performance sustained over many decades. So to some extent, I guess it's to do with many factors, but I do very much agree with you that the institutional stability and the reliability of institutions is hugely important. And I think within that, the expectations of companies at a time of uncertainty and at a time of political stress are also hugely important. And I wanted, Lucy, to ask you, you are one of the champions within the firm of what is popularly referred to under the acronym of ESG, environmental, social, and governance issues, essentially corporate behavior, as we used to call it. And we're seeing I think, greater scrutiny of how companies behave. And we're seeing some new regulations coming in which are driven by popular expectations of the behavior of companies. Can you say a word about what you think all this adds up to? Can people in boardrooms just get on with the job as they used to and deliver returns for their shareholders? Or is the regulatory burden and the burden of expectation just going to keep mounting on them?
Yeah, I mean, look, ESG, as you've just alluded to, is a massive topic, and I think whether you're kind of agnostic towards that acronym or not, it's undeniable that the elements that it encompasses are hugely important to business, essential to businesses, and should be on the radar of every C-suite. Ultimately, I mean, there's an increasing body of regulation around ESG, but there's also a number of kind of voluntary frameworks as well, and it's a bit of an inconsistent patchwork, and that potentially could present challenges. But ultimately, taking a step back, what ESG is about, in my view, is having a sustainable business, and that doesn't mean just environmentally sustainable. It means sustainable for the long term. How are you going to operate your business so that it still exists in the next 10, 20 years and it's being profitable? And those are the things that I think that companies need to adapt to and be ready to adapt to. And there's a lot of reports out there that show that where certain external factors arise, that it may be the pandemic, it may be conflict elsewhere in the world that's kind of impacting on your business for all of the reasons that you and Liz have just been discussing. Companies tend to be a bit more agile and able to respond to those where they've kind of got a really strong ESG framework that's really embedded into the strategy of that organization and the purpose of that organization, and it enables them to be a bit more nimble. And that's my view, but I think that's not an uncommon view either. There's obviously a really high regulatory bar there already in terms of, I don't know, tax, in terms of kind of salary constraints, in terms of other kind of frameworks within which organizations kind of operate. And a well-informed ESG strategy may elevate that, but it's impossible to ignore. And I think that a workforce as well, and stakeholders external to business, whether it's customers, whether it's shareholders, will also inform what a company does around these factors. And by that I mean employers often now don't just want to work in an organization, they want to work in an organization that they feel committed to, that they feel aligned to in terms of a purpose and values, and that's borne out in terms of, you know, greater productivity, in terms of retention of talent, in terms of attracting talent, and perhaps, you know, you could go even so far as to say it makes you more resilient, therefore you've got a healthier workforce. And likewise with your customers and stakeholders. Yes, it all comes down to money, but, you know, with increasing pressures around all of these issues, third parties who are going to engage in business with you in one way or another within a supply chain will be looking at these factors because it impacts on their own performance and what they also want to present as a business as well. And I guess taking a step back to what your original question was in terms of, you know, can you just get on with the job, or how much does this really impact on what you're doing? I think it all really comes down to the reputation of a business, and ultimately the reputation of any organization is its key, and that takes years to build up. It can take a second to kind of fall away if they take a misstep somewhere along the line, and the course of public opinion is strong in relation to that. So I think, you know, gone are the days where a company can just go through and do what it wants to do, notwithstanding any regulation or not. There are higher societal standards these days, and I'm obviously talking generally because it depends on which kind of jurisdiction you're operating in, but if you're operating on a global basis, you will be held to a higher account, and there's a lot of a risk there.
And just as a reminder to those of you listening, if you have any questions, do please use the Q&A box to put them in. We're getting towards the end of the webinar, so get them in now if you want. And Lucy, what happens if companies get this wrong? What happens if they fail to deliver on the expectation, or if they, you know, dress themselves up as something they aren't? how much trouble can a company get into on the ESG front?
I would say a lot. It goes back to the reputation piece I just mentioned. I think that's central to it. You know, it takes years to build up and a minute to lose it. And I think, as I said, that goes to public opinion and customer base as well as other stakeholders like shareholders. But there are also increasingly more sophisticated activists out there, entities like Client Earth, who, you know, I use the phrase lawyered up, but they are seeking out, you know, bigger organizations that they don't think are doing the right thing. And this is particularly on the climate change, the kind of environmental sustainability side, to make them do better. So they will see and look at what communications an entity is putting out in terms of its pledges and what it's going to do by when to become net zero, and say, well, hang on a minute, I don't think that you're doing enough right now to even achieve that target. And we've seen examples of those from the oil majors, but also other entities as well on other elements of these things. And likewise, you know, shareholder activism is not an academic subject. That is a real thing where, you know, shareholders are increasingly wanting corporates to do things in a certain way, and that may be around, you know, investing in more sustainable fuels as opposed to, you know, your traditional oil and gas, and using, you know, the weight of that element to be able to affect change in those ways. On top of, you know, potential regulatory intervention, if you're not reporting the right way, or if your standards are not at the relevant level. And I think, you know, in that regard, you've got to be careful what you put out there, because if you're saying, well, we're, you know, carbon neutral, or we're doing X and we're great on the sustainability front because of X, Y, and Z, you know, there's a likelihood that you'll be accused of greenwashing, and there's all sorts of regulation in and around that, you know, whether it's, you know, an advertising standards piece or whether it's something else. And again, even if you're not breaching regulations, it's going to be very easy for the public, I'm saying in the broader sense, to be able to kind of bring you to account around that. And I think that's something that every corporate will want to avoid.
Thank you very much, Lucy. And I think that focus on understanding how your company's operations impact on the communities and the wider society in which you operate, and making sure that you are able to present a fair and balanced picture of the benefits you obviously bring, but also some of the challenges that might be created is hugely important. Look, we're getting to the end. I've an economic question, Liz, if I could fire it at you, which has intrigued me a lot, which I'm old enough to remember when interest rates went up absolutely dramatically as we were ejected from the exchange rate mechanism, and my mortgage went from being painful to being excruciating. We've seen interest rates go up, I think, roughly 15-fold. I may have got that wrong, but it's about that. And it's caused, obviously, a tight squeeze on people's finances, but it doesn't seem to have had the same dramatic effect in terms of home repossessions and so forth. Well, what's the explanation for that? How has the Bank of England got away with it?
So I think there's two schools of thought. One is that the impact is still to come, that we've started to see it, but that these things are very slow burn. And you know, while some people have fixed onto higher rates already, many more will do so in 2024 and 2025. So that's one argument. But I think you're right. I think we would have expected to see something more dramatic already by now. And so the offsetting factors, I think, are first, you know, compared to last time interest rates were this high, the private sector has deleveraged. So households have less debt and companies have less debt, and therefore, you know, we you know, the impact is more muted. I think with mortgages in particular, households have been stress tested quite stringently post-global financial crisis. So there was none of this kind of subprime lending risk that we had last time. If you have a mortgage in the UK, it is because you are earning a certain amount of money and you can absorb a bit of an increase. And then the other thing is that employment has stayed so high, or unemployment has stayed so low. So where the wheels start to come off is if you lose your job and you cannot pay your mortgage. So you know, if your mortgage goes up, it hurts, it's not nice. You might have to cut back on some of your subscriptions or not go on holiday this year, or you know, whatever it is, but you will keep the roof over your head, generally speaking. The wheels come off if you lose your job and you cannot make those payments. And yeah, that's, I think, what we seem to have avoided. Sorry, are you still with me? I seem to have lost you.
I'm still here, absolutely.
Yeah, you're still here.
I hope I'm still here. We've now lost your sound, Liz.
Oh, we can't hear you, Liz.
We can't hear you, Liz.
And we are getting less back in terms of public services, and that's because we're spending more on debt interest in our economy. So I think that's the big issue. The private sector has come through it, but we're still paying the price on the public sector side.
Absolutely. We lost your voice there for a bit,
Oh.
I'm afraid, Liz. I don't know what happened. The system ejected you, but I think we got the point. I think we're getting to the end. I wanted, given that the audience for this, and thank you very much for joining, the audience is overwhelmingly female, reflecting the women in finance theme, and it's splendid to have an opportunity to celebrate that. And with two women who have made a huge success in two different finance-related careers, I wanted, if I could, to end on a sort of personal note and ask you both just to say a word about succeeding as a woman in the traditionally male preserve of finance and the city. And maybe, Liz, if I could bounce that one at you first.
Yeah, sure. I mean, look, I work for a really good bank, and a bank that really cares about these issues and has really pushed this agenda. So I've never felt at a disadvantage for being a woman. And in fact, as a female in a male-dominated profession, it's actually advantageous in the sense that, for example, if the inflation number comes out tomorrow and the BBC wants someone to comment, I hope I'm not being indiscreet to say they will phone and they will want me rather than one of my male colleagues to speak about it, to give the impression that all the economists in the world are actually female. You might get that impression watching television. So, you know, in that sense, it's been advantageous, and I felt very supported in the bank. But of course, there's more that can be done. I think, you know, there's no structural disadvantage at an entry level. So you come into work for a company, and I think, you know, hopefully for at most places, you know, women aren't at a structural disadvantage. The issue is as you progress, and particularly for women when they want to have families, it's about whether those needs are balanced and accommodated so that you aren't falling behind. And I think one area which has really improved but may now be receding is working from home. So obviously in the pandemic we moved to a very, very flexible way of working, and that helped not just women but men who wanted to be at home with their families as well. Now, when I talk to companies, more and more I'm hearing people who are less keen on working from home and less keen on that flexibility. And I think my worry would be, you know, each to their own. Different companies and different sectors and different, you know, lifestyles will make their own arrangements. But I hope that bit, which actually I think has been really positive for women in the workplace when they have a young family, I hope we don't lose that as we move further away from the pandemic. But yeah, as I say, for me personally, you know, I've always felt very well supported at HSBC.
Lucy.
I would agree with a lot of those observations, and so I'll try and make some different points. I think it's still very true, and so talking about the law, I would say in particular, there's still, I guess, more women graduating in law and coming into the law as graduates, just, you know, marginally speaking, compared to the top. So you get to partnership and then even equity partnership, and the numbers diminish rapidly. And I think, you know, that's still a head scratcher. And I think Squire and Boggs and lots of the global firms are doing a lot to try and redress that balance. And I think it's important and it's important to think about why that is. Obviously, not every woman or every person should be expected that they want to make partnership or whatever the senior level is within the organization. But I don't think the assumption should be that they don't want to reach that level, or okay, they've now gone off and had a family, so that would be their priority. I think that would, and I don't think many people think that way anymore. But I do think sometimes it's slightly more incumbent on women to make it clear where they want to get to, whereas for a man it may be assumed, that yes, where they want to reach is partnership, whereas a woman might have to be more vocal about that. And I think we just have to challenge ourselves around those kind of assumptions. I think, sometimes in the workplace, and I'm speaking generally, and for the avoidance of that, I've been at this firm for about 18 months or so and spent time in another firm previously. So I've got some varied experiences, but smaller kind of microaggressions still do exist within workplaces, whether or not people realise it. I don't think that, or I've not encountered any direct sexism in my career before, but I think sometimes smaller things come out where you realise that you're being treated perhaps in a slightly different way because of your gender, or there's certain assumptions made around you. But I do also agree with Liz that sometimes it helps being one of the fewer women around, because you may then be asked and given opportunities to do things, whether it's taken along to a meeting or a pitch to balance out the numbers, or to be the person that they want to speak to, show that there's a diverse community. And I kind of would never make any excuses for that, because I think it can help. And I do still really love the fact that sometimes you go into a room and you realise, wow, this is like majority women, and we're all kind of senior women here. And sometimes it's 5 minutes into a meeting before you recognise that. And I still enjoy that, because it hasn't always been like that during my career at all. But I guess this is a topic we could speak about for ages, but I think one point I wanted to make is that, sometimes an expectation can be on anybody that you kind of maybe have to slightly display more traditionally male behaviours to get to the top. I've had, feedback to me earlier on in my career about I should have sharper elbows, for example, and move those things out. And that's not really true to who I am. And I think what you have to still be is your authentic self. We spend a lot of time at work. It's a huge part of our lives, but and we can't, if you try and be somebody that you're not, you'll be worn down from that, you'll be burnt out, and everybody is accepted, and you should be able to kind of behave in your way, the real way, of course in your professional way, which may be slightly different to how you'd act at home, but through that you will still get to where you want to get to, as long as you're kind of clear about that, and clear in your mind as to what your objectives are.
It's fantastic. Thank you, Liz and Lucy, for sharing those thoughts. And Lucy, you allow me to end with my favourite quote from Shakespeare, which is advice given by Polonius, to thine own self be true. And I've always felt that that's hugely important. Paula, I think back over to you, and we will draw this to a close.
Thank you very much to our speakers. I think that was a great session and really informative. I just wanted to add something in relation to Lucy and Liz's observations, and just explain to you the reasons for putting the Women in Finance network. And some of us have been around for a long time, and perhaps were the only women in the room when we walked into places 20, 30 years ago. And I attended, just to give you a personal experience, I attended a leadership course at Harvard, where the only female professor on the course gathered all the women, of which there had to be said were very, very few, and said, it's really important that you find your voice very early in this program, because typically women would go in, they would let men speak first, they would deferential. And I think that stems from, just walking into a room where not many people look like you. And obviously for people of colour now, we're trying to deal with that aspect of diversity. So I think, everything we've done, it's changed hugely during the course of my career. But one of the really key reasons for putting this together is so that women can find their voice. And Lucy and Liz are examples of two magnificent voices we've heard today. But I also think that women approach this with very much in mind best player plays, not it being the exclusive preserve of women. And so who better to present this session in terms of his experience and expertise Matthew. So thank you very much to all of you for sharing your experience and also your thoughts on the situation that we're all facing. And thanks to everybody for dialing in, and I hope we will see you all later. Thank you.